started the recording of this webinar. And just a heads up, just so you know, I'm glad you're here as a live participant because sometimes these go-to recordings, they don't work so well, you know. But lately
we've had some issues before.
Yeah, but lately the recordings have been okay. So just so you know, guys, you know, we are recording this. We will send this out. There's going to be some giveaways that you're going to get at the end of this as well, and they'll come to you in an email. That email will go out, if not by the end of the day today, the first thing tomorrow morning, you'll get it. And so you'll have a copy of this recorded webinar and, you know, a couple of other little giveaways that we'll give you guys. And so with that, we'll go ahead and get started. Again, thanks for showing up. I'm Frank with the National Real Estate Post here with Tom Hutchens of Angel Oak Mortgage Solutions. And I just want to kind of tee this whole thing up in this fashion. Just as a reminder, guys, the reason that you're here is because you had some interest in seeing some loan products that might be able to help some of your borrowers to increase your current pipeline. And these would be borrowers, guys, that they might not necessarily have a whole lot of money down. They may have a recent credit event, you know, foreclosure, bankruptcy, whatever the case may be. That is keeping them out of government guidelines, FHAVA guidelines, and QM guidelines. And so surprisingly, there's still product out there that can help you, or products, I should say, and that's what Angel Oak has. So when we go through this presentation or this webinar, guys, I want you to keep in mind that everything you're going to see here today is not only going to be something that could just immediately add to your current pipeline. I mean, that's good. We want to do that. Right, but also just take it all in and digest it, because remember, this is also a great conversation starter to be able to work your way into doing presentations for various referral partners. Of course, obviously, real estate offices, but others as well, because we're going to go through some scenarios and through some products that Angel Oak has here that can help you out. That you will be able to find potential borrowers to fit these products in multiple places, not just from your real estate partners or your past client database, but multiple places. And Tom's going to go over where you can dig up this business, and it doesn't hurt to go and dig up this business. What, Tom?
Well, I was just going to say that to me is one of the most important parts about this alternative lending, the non-QM space, is that it's an education. You know, it is. These are tools and these are programs and products and kind of a new lending environment that originators can go and share with realtors. And you know, that's what you and I have talked about in the past. Is, you know, take this information and go share it amongst your referral base, because that will make a difference. It's something you can differentiate yourself. It's just it's good for everybody. And we've been on this education mission for over 4 years now, and people are really understanding it now. So it's great.
Yeah.
Good timing.
So you know, take all that to heart and remember. And the good news is you'll get the copy of the recorded webinar and some other things, so you'll have something in your hands that you can kind of get started with going out there. Now, before we turn this over to Tom to run through some stuff, I just want to tell you guys, you should have a little questions icon or box on your screen where you can type in questions and things like that. Go ahead and ask some questions in there as we're going through this webinar. The nature of this webinar is Tom is actually going to go through some genuine real live scenarios where they've been able to help people, and the nice thing about that is that's going to help trigger you guys to go, God, I had something like that, or oh, that makes sense. Oh, you know, there might be some things that pop up in this presentation and these scenarios that trigger you to realize you've got a deal that you might be able to plug in. But also, just as we're going through, go ahead and ask questions as we're going through them. And even, you know, put in a little scenario in that question box. If you happen to have one you're working on now, or one that just got by, or one you think you got coming up, go ahead and drop in little scenarios into the questions box. When we get through, you know, this, and I'll be checking on the questions as Tom is presenting, and throwing a few out there that fit the presentation in time. But what I wanted to close with saying here before we turn this over to Tom is just remember that anything you put in that questions box will get answered, because at the end of this webinar, even if we don't answer it here on the webinar, at the end of the webinar, all those questions get forwarded along to the guys over at Angel Oak, and their appropriate account executives are going to get that question and give you a call and go through that with you. So even little scenarios, that type of thing, go ahead and drop them in there. And again, just don't be alarmed if we don't get to it. You will be answered. You will be
Yeah,
answered. So this is the
we'll get
next.
to as many as we can. But yes, good,
Yes.
great point, Frank. We'll
Yeah.
follow up. We have those questions, and we'll get answers to you as quickly as we can.
Yeah, so this is kind of a super good opportunity, this webinar, to get those things out on the plate and over there knowing, aha, somebody's going to get back to me and I might be able to scrounge up a deal out of this. So I think that's about, all I wanted to do to tee things up. And what I want to do now is hand it over to you, Tom. And what Tom is going to do, guys, is he's going to go through some scenarios. Just because we talked about this, we thought the best way to really show it what can be done is to actually go through some real scenarios that have worked for people. So
and really, Frank, if you don't mind, I mean, and the reason that we do that is because, we a lot of times we educate people on non-QM and what it means and how, comparing it to the past and the 2005 subprime world and all that, and all that makes sense. But when we really start talking about the actual loans that we're closing, then I think originators kind of the light goes off because, oh yeah, I remember that borrower, I remember that situation, and since 2009, these situations haven't been able to be addressed, and those borrowers have been just completely turned away in any of those scenarios. So
cool.
That's really kind of why you and I thought this would be a good route to go.
Definitely, yeah. I'm going to go ahead and hit the button to make you the presenter. So you should be able to throw your screen up there for us.
Yep.
And go ahead and take it away, Tom. And like I said, I'll just jump in time to time. I might bring something up, and I'll be keeping an eye on the questions. And as I see something pop in that might be relevant, I might interrupt you and say, hey, somebody's got a question here real quick. So
yeah, please.
Rock it, Tom. Let's go.
So you can see my screen, just to confirm. Okay.
Yep.
All right. Great. So anyway, here's just some of the situations that we thought it would be important to kind of just walk you through. But and again, these are real loans. These aren't conceptual. These are loans that have come to us and we've closed and we've funded. And so this is really just examples. And as Frank said, if you have some other questions, some other scenarios, some other just loan deals that you've seen come across your desk in the recent past, then put those in there and we'll see if we can get those addressed. But here, this first one, we have a borrower that had a bankruptcy in 2014, and then to make it a little worse, they tried to hold on to their home through the bankruptcy, but the following year, 2015, they had to actually foreclose, or the bank had to foreclose on their home. They had about a $350,000 balance on that mortgage. And so they came to us wanting a $182,000 loan with 20% down. They still had good credit scores. The thing that is interesting to me in this the new non-QM lending is that a lot of times today it seems credit scores are not as indicative of some of the credit history. So in fact these are what we call storied loans. All of these scenarios, the borrowers have a story, and if you look here, this was the borrower owned a business, and they were the primary wage earner, the primary borrowers, was diagnosed with cancer, and so basically, in a nutshell, that business had to be neglected during that very trying time for the family, and so they went from a dual income, self-employed, and a co-borrower to a single income, and they just frankly couldn't afford the home. So that was the story of what happened, and we could see that on the credit. We see perfect credit, we see everything's humming along, and then boom, something that life event occurred, and that's when things really started to unravel. So they lost their home. But they've been renting since they lost their home, and that's the one thing that we talk about stories. We look at, like, how did the borrower react to their situation? Did they go out and rent something that they could afford, and they have a track record now of a good pay history? All that goes into the story. And so on this scenario, not only did that happen, they went and rented, but the primary wage earner, who had been self-employed, went out and got a degree in a specific field so that he could actually work in that field. And so this was a loan. It came to us, and what was really cool about it, I was involved in the loan, and the borrower sent this so thankful email when it was all said and done, because they got a house again. They got into the neighborhood. Just because someone experiences a tragic, life event doesn't mean they don't really, their desire is to be a homeowner again in most cases. So this scenario, we were able to get the borrower into the house. You look at the profile, 680 credit scores, DTI, back-end DTI of 20%. So these loans are extremely good. Frank, I think before everybody jumped on, we talked about performance. We have loan performance. A lot of people, it's not even a misconception, but there is a perception that non-QM means high DTI, high risk loans. Well, that's just really not the case. This scenario we're looking at, they had a 20% back-end ratio. That's not a high DTI loan. Non-QM means they're just not going to fit the agency guidelines. And with their bankruptcy and foreclosure in the recent past, they're not going to be able to qualify for an agency loan. So
can you touch base in this case? So here you got these guys, and they had this foreclosure in 2015, right? Mm-hmm. Less than 24 months, but now they've been renting. Got a good job now, so the DTI is mm-hmm. looking good. How about that 20% down? How did he come up with? Do you remember how they? Where did they get that? Because they were.
Yeah, no, that's a great question.
And now they've got 20% down. So
right,
how did that?
Right. Well, and I think in their situation, this had to do with that borrower going back and getting educated. And in fact, this 20% DTI is only based on the co-borrower's income. I believe we mentioned that it was a nurse. Yeah, this was based on the nurse's income. The other thing to point out is look at the balance of the loan they foreclosed on. They foreclosed on a $341,000. It was probably a $400,000 or higher loan, but their balance at the time was $341,000. They came to us for a $182,000 loan. So they're right sizing financially. It's not that they're right sizing a house. We hear that term a lot. It's time for people to right size. Well, they basically cut their mortgage exposure in half, and so where their 20% came from, because they rented for those 2 years. The primary borrower went and got a degree and got a good paying job. So their ratio with the primary borrower was even lower. So they've been able to save this money over time.
Gotcha. Okay.
In this scenario, but I think, just so people are aware, funds and access to funds is really, we accept gift funds all the time, and we're very comfortable with that. We believe our loans, it's important for borrowers to have skin in the game, but that skin can be family money or their own. So those are the kind of scenarios that we look at.
Okay, so in this scenario, these guys happened to save the 20% down because they mm-hmm. could, because of their changes, which totally makes sense. She was making great money. Now he's making great money. Honey, we'll just put all my money in the bank. We'll just save it up.
Yes.
And then we'll go do that. And people really do that, and that really happens. But given this scenario, if they, said, hey man, my uncle's going to go ahead and drop me the down, and give me a gift for the 20,000 or 20% down, that would have been, as long as all of your gift guidelines were met, that would have been okay.
Absolutely.
This is a good question. What about reserve requirements? Was there a reserve requirement in this scenario on this product that you got?
Yeah, all of our loans do require reserves.
Okay.
This scenario, 3 months. So So after they've made their down payments and covered the closing costs and all that, we do have a minimum of 3 months in reserves. Some of the programs might require a little bit more, but 3 to 6 months is kind of the standard.
And given this scenario, she's a nurse, and she's probably been a nurse a long time. She probably has some mm-hmm. great retirement things set up, and that could have been used as the reserves, right?
You use those all the time.
Yeah.
Yes.
Okay. Cool.
Yep. So.
All right. Excellent.
Anyway, all right. So here's another one. We had a borrower, good credit history, continued good credit history, but they had an investment property lot. So, you think about it, real estate, a lot of people have acquired real estate leading up to the financial crisis, and a lot of people have maintained that real estate, but there are instances where it just doesn't make financial sense. Perhaps the value of those investments went down so significantly. You tried to wait for it to come back, and it just didn't come back. And so that's what we have here. We have a self-employed borrower who had an investment property. It happened to be a lot, not even an investment home, and they lost it in 2014, but they had a mortgage on it. So that's a foreclosure, whether they're renting it out as a true investment property, or if they just own it with a mortgage on it. But this was a great example. We have a self-employed borrower. We use their tax returns to qualify their income, but it was a $544,000 loan. So this was not in a market with the high balance loans. So this was a jumbo loan. So if you're trying to get jumbo financing and you have a foreclosure 2-3 years ago, you're not going to be able to get your standard prime jumbo loan. So that's why this loan came to us. So really just another good story. It was their primary residence. Again, another 80% loan, so they're putting 20% down. 700 credit scores, debt to income a little higher, a little over 40%. I think it's important for people to know we will go up to a 50% back in DTI ratio. So we are good in the right scenario. It's not just an open-ended 50% for anyone, but when they have a good residual income and their credit is good and some other key factors that we're looking at, we're going to allow to exceed the 43 that's used in the QM world. So again, good residual on this borrower. They had $15,000 a month verified by tax returns. So they brought a lot of money to closing. And then you mentioned earlier about reserves. They had a $78,000 balance in an IRA, and we were able to use that. So they had it's not required, but they had 2 years of reserves in their account. So love this loan. Great loan. This looks a lot like what we see and do every single day. Wow.
And this person is self-employed in the real estate business.
Mm-hmm. Absolutely.
So, it's true. The self-employed borrowers, and for the loan originators watching today, I mean, you might have a handful of real estate partners that you're working with who they're not going to fall into QM, you know what I mean, or a Govy, yeah. And they're going to need something along these lines. So basically here you've got a real estate agent, we'll say, I don't know what he was or she was, but a real estate agent for 10 years who was able to pull this off. And again, so this one, you were at an LTV of 80 on this deal. Mm-hmm. We did have a decent FICO on him, so that was good.
Yep.
Back-end ratio is not too bad. But like you said, you've got a recent foreclosure.
Yeah, it's a foreclosure. Conventional financing is off the table for these borrowers.
And you're a jumbo. So, and you're able to pull it.
We always talk about the tight agency guidelines, but when you get into jumbo, I mean, you take those and just cut them in half. That box gets just even tighter.
Okay. All right, cool. Well, remember, guys, you can fire questions away if you got any other questions to ask Tom as we're proceeding through these scenarios. I haven't really seen anything pop up, but I think we're handling it all. I think we're answering them as we go through, so we're good to go there. Let's continue on.
Yeah. Okay. Well, this next one I think is where we've seen a lot of growth in our business, and I think a lot of it is kind of what I mentioned earlier. This is a scenario that many loan officers can relate directly to. So what do we have? We have someone that walks in with really good credit, 721 scores and no derogatories at all. They didn't have a foreclosure 2 years ago or 5 years ago. They have perfect credit, 721 credit score, but they're self-employed. And we know what do self-employed borrowers generally do? They have really good accountants. One of the benefits of being self-employed is that you get to write off a lot of your personal life through your business or run it through your business. So your tax exposure is limited, and that's really the job of the CPA, is to minimize that self-employed borrower's tax exposure to the IRS. So that's what this scenario is. Nothing revolving around credit, but it's all about income. So we have a $328,000 loan. This scenario happened to be a 70% LTV, but I'll talk more about what we can do. That's certainly not the highest loan to value. We will lend up to 90% for these self-employed borrowers. Again, 721. But what we did on this one is we looked at a 1-year average of their personal bank statements. So they had a business account. All their money came into their business, but they paid themselves every single month. So every single month they're transferring money from their business account into their personal account. And we look at that personal account for 12 months, and we look at that cash flow, all the deposits. We use 100% of those deposits. We come up with the average for the 12 months, and that's their income. And we use that to qualify them for these loans. So happen to be a first-time home buyer, which I think is an interesting, we always hear, what can you do for first-time home buyers? Why a lot of these self-employed borrowers are first-time home buyers is because since 2000 and really since the crisis, they've had no options. If you can't qualify on the net income on your tax returns, you're not getting a conventional loan. You're not getting an agency loan. So we see a lot of first-time home buyers for self-employed individuals, and there's over 15 million self-employed borrowers in the country. So we're not talking about a small pool of potential buyers and borrowers. It's large and growing. You look at this gig economy. I think more and more people are going to be self-employed in the coming years.
Yeah, you've got some questions popping up now here, Tom. So let's address them as best we can. And again, guys, if we don't fully address it, you will be contacted by an Angel Oak rep. But basically, it looks like we've got somebody presenting. Lisa here is presenting a scenario where it's kind of a hybrid borrower. This borrower's got W-2 income, right? And 1099 income.
Yes.
And of course, against the 1099 income, they're writing a bunch of stuff off.
Yes.
Okay.
Yes.
So would you look at that as we're going to take the W-2 income, and then could you do bank statement on the 1099 side, or
so we can, and it kind of depends on. Certainly, we need to look at that in greater detail as far as where the money. But if we can identify the W-2 income and we can remove that from those bank statements, we can count it, but we just have to remove it from the bank statements. And if that's clear where we can do that, and they've been self-employed for 2 years and that kind of thing. So yes, we can mix and match. A lot of times we have not one borrower, but it's you have a spouse, husband and wife, and one is self-employed and one is W-2'd, and they're on the same bank statement, and we do that all the time because you can clearly see those deposits from the W-2 borrower, and then the other deposits are the self-employed borrower.
Got it.
And so we take both. So that's a great question.
Yeah, this person's also above a 620 at a 629 on the FICO.
Yes.
So you guys can play in that range on the FICO.
Absolutely. Oh yeah, absolutely. And I'll show you our little tool here online where hopefully everybody that's watching has access to a computer and they can kind of even follow along on our website.
Couple more quick questions before we move on, just so we can get these done.
Sure.
We have Eileen, and it looks like she's asking, do you need a profit and loss statement for self-employed buyers, or do you just go back 2-year average? Do you worry about profit and loss? Or?
All right, so that's a really, really good question. This is somebody that's probably somewhat familiar with the bank statement programs. So there's really two kinds. There's personal bank statements where we document they've been self-employed for a couple of years, then we're looking at their personal bank statements, like I mentioned, for 12 months and using the average of deposits, and we use 100% of those deposits. Now, there's also a business bank statement program where the same scenario, borrower's been self-employed for at least 2 years, but we're using the deposits into the business. So, if you're using a business account, every dollar that comes in is not your net income. So what we get is an expense factor letter from a third-party tax preparer. Doesn't have to be a CPA, just has to be someone that says, hey, Tom Hutchens business, Tom Hutchens Inc. operates at a 40% net level compared to their deposits, and so we'll take those deposits over 24 months, deduct the 40%, or has a cost factor of 40%, so we'll deduct the 40% and then average those deposits over the 24 months, and that's their monthly income.
That's awesome.
Was that clear? Did I explain that?
No,
A lot of detail. So.
And I think with this particular scenario, it's definitely in the questions box. So I think when your AE gets in touch with that person, that they can really dig into this one. There might be something there on
Right.
this deal from what I can see. Here's another quick one. Any option for basically we've got this is Myron, and Myron's basically got somebody who's self-employed with 800 plus credit scores, but since he's self-employed, he's having trouble qualifying for a refi, where he just wants to lower, term, go from a 30 to a 15, or lower the rate, or whatever. So. Yeah,
we absolutely. In fact, our average FICO on this program is north of 730. So, we will go down to the 620, but that's the majority of who we see are business owners that it's not a credit issue at all. It's like I mentioned earlier. It's simply a tax return issue. So yes, we do rate and terms. We can do cash out. We're seeing a lot of people wanting to tap in. Self-employed borrowers, it's been a pretty good housing market over the last handful of years, but they haven't been able to access any of that equity. So we're doing a lot of debt consolidation. Those kind of self-employed borrowers, use debt to grow their businesses. So debt consolidation on the bank statement is a very popular and common loan for us.
Okay, cool. And I know we got to move on to the next segment here, but just before we do, I just want to let Myron know, because he's asking, hey, on this 12-month personal bank statement deal, what's an average rate? You're going to get into that when we go to the next piece. Yeah, so Myron, hang tight on that.
Yeah, right.
And we've got, let's see, Okay, so we've got Dan who's asking if you've got any help to or documentation that can help, marketing materials that can help show potential buyers, I believe is what he's asking.
Yeah.
That they might have scenarios that work for them and why. But Dan, that's going to be I see your question is a little more detailed than what I just said, and the AE will get with you on that one.
And we're going to talk about a little bit of that here in a minute. So
yeah,
kind of a good segue maybe.
Yeah, see, this is what he's asking for. He's saying, how do we get clients who have a negative situation who think they can't do anything to engage with us? And I think that's going to be through your education process and your marketing materials. And we're going to get to that here shortly, Dan. So great questions.
Well, you know what, though? That is kind of what I even said earlier. It's education. It's educating. In fact, I think next we're going to talk about where do you find these borrowers, because we get asked that all the time. So if you look on the screen, look at turn downs that you're aware of in the last, how long you maintain that information. But a lot of people have seen these types of loans in the last 6 months, in the last 12 months, whatever. Look in that book of business, and if you keep up with why you weren't able to help somebody, pull up these self-employed borrowers who the loan was declined because their tax returns weren't there. The thing that I always like to talk about is realtors. Educate realtors, because I believe, and you can probably attest to this, Frank, these realtors have been trained to kind of weed out borrowers that aren't going to get a loan. Since the crisis, they kind of pre-qualify them on their own. Are you self-employed? Have you had a foreclosure? They're asking these questions, so they might be stopping them from ever even picking up the phone and calling you, because they're not aware these programs are available. So I'd spend a lot of time talking with realtors. We've got presentations that we can actually give to you that you can brand yourself and present at realtor offices. To me, that's a big one. We've got on here accountants. Obviously, accountants, CPAs, they're the ones that are doing these tax returns.
Yeah.
They know these self-employed borrowers who have really solid income, but they're good at what they do. So they're minimizing the borrowers, these business owners' tax liabilities, but they know they want to buy a home. And so a lot of these self-employed borrowers will go to their accountants and say, hey, we're trying to move to this neighborhood. This is the price range of homes, but I don't think I can get a loan because of my tax returns. Do you have any ideas? Have you be the idea that the CPA can send them to?
Yeah, it's interesting, this part, because I just remembered this, and I don't know why I brought this up. Didn't bring this up on this is a different nature of a webinar, but I had a guy, I was a branch manager, and I hired this guy, and he was just There's a very interesting loan originator, man. He just had he was the ultimate niche guy, right? I mean,
Right.
this guy
Yeah.
never brought in, like just a plain old deal. It was always something quirky and niche. He was this niche guy. But a good portion of his business did come from CPAs because he actually presented himself to local CPAs as the self-employed expert. So he went in there saying, I'm the self-employed borrower expert. I help self-employed people. So if you got self-employed guys that need write-off, need to increase their mortgages, but they can't get the loan or whatever, I'm your guy. I help these guys. And he had a great little book of business coming out of those guys for the self-employed guys. And this is back in the day, just to give you a heads up. He was a Washington Mutual, guy.
It'll you. Oh, yeah.
Yeah, and so we could still do all those kind of products. This is back in the day. But they were very much geared. So the old WAMU products were really wonderful for self-employed borrowers. I mean, and so, but so you can really, if you go in and if you can be consistent as a loan originator with anything, and if you can be consistent with just, every couple of weeks hitting up your CPAs or trying to work CPAs as a self-employed expert, which is what these guys really specialize in, I guarantee you're going to pull some deals out of this thing. The other thing, too, before you move on to financial planners and bankruptcy attorneys, Tom, is just you touched on realtor. And what I want people to understand is true. What Tom's saying is you might have some realtor partners out there that, have been conditioned to turn people down. You know what I mean? However, a lot of realtors, they don't even get into that. They just go, just talk to this guy. You know what I mean? Just talk to this guy and see what you can do. And they're not necessarily worried about, they let the loan officer figure out if he can qualify or not. But what could help in this scenario is, and another question was, am I going to get some marketing materials? The answer is absolutely yes. Angel Oak will provide you with marketing materials. But if you can work with some of your realtor partners who maybe aren't really heavy on listings right now, who are looking for buyers, and they do have a past client database, maybe you can work with them to give them the marketing materials to send out to their past client database saying, these products are available. So this isn't your past client database anymore. Now you're infiltrating your realtor partner's past client database with some marketing materials that these products are available. Do you need it, or do you know someone who might need it? So you can look at your realtor partners in a couple different ways.
So Frank, I love that because, we keep hearing about the lack of supply in the real estate business, and we're all, regardless of your market, that is kind of the current reality. How many of these self-employed borrowers are the homeowners that aren't selling because they don't think they can get another loan? They got a loan in 2006, and they've inquired a few times, and no, need to see those tax returns. Got to see those tax returns. So that's a great point going to the realtors to find new listings. That can open up a lot of doors for your customers.
Yeah, a listing and a buyer. So you get them both. So no, great stuff.
So financial planners, bankruptcy attorneys, kind of the same thing. There's these are just all different resources of potential borrowers that they have contacts, and they can help you expand, and you can help them provide a benefit to their clients.
Cool. What if we wanted to? What if we want to just jump in and see if this guy's even going to fit? You know what I mean? How do we do that? What's our best way of going about that?
Okay, good question. So let me just change gears. You can still see my screen, I hope. For those on the call, this is our website, angeloakms.com. So angeloakms.com, and I'm actually on our main page. But there's just a couple things that I want to show you here that I think will even address some of the questions that people were asking. You can get answers really quickly, and so I want to start there with quick quote. If you just see right here, we have a quick link. We have one going across the top under tools, quick quote form. But quick quote is really an easy place to get questions answered. And when you go in there, it asks for your company name, and I'll explain why. But let's just say I'm with ABC Mortgage. And if our company recognized ABC Mortgage, it would actually pop down, and you could just click on it. So it says if that's the correct company, click log in. No login required, just the name of the company. But then you can see this is the quick quote form, and we ask you just a few questions. I'm going to shrink this down just a little bit so you can see kind of more of the screen. Is that too small, Frank, or how's that look on your end? Frank, you there?
Sorry, I was muted. Yeah, I looked good.
Okay. Okay. All right. I was like, uh-oh, we're having a technical difficulty.
Not
So,
that again.
what now? All right.
All
So,
right.
so again, here we ask a few questions. You need to put your company name in, and then you're off to the races. But so we ask credit score, and I'll just throw out a scenario. We can start just 700 to 719 loan amount. We just have ranges. Let's say this is a good one from 750 to 999. LTV, pick our average LTV right now is about 75, so we'll just ask 70. Then housing history. So this is where this might be a problem that somebody has. They've had a foreclosure in the last 12 months, 12 to 24. But just to start, let's just say zero times 30 in the last 12 or 24 months. And as soon as you've answered just those 4 quick questions, scenario opportunities or potential loans start popping up. We've got transaction type purchase. You can change that to rate and term or cash out. Income documentation. You've got 12 months personal, 24 months business. We have an asset qualifier, which we can talk about later if we need to. So then occupancy, obviously that matters, and then we have a foreign national loan. But when you get to this point, you see options already down here. And so we have different programs. You as an originator don't have to know the difference between the programs. It's just how we refer to them. This is giving us a portfolio select or our non-prime. We requested a 70%, but you can see we also give you what the maximum loan to value would be, and that would be 90 on this program and 85 on our non-prime. It gives you rates right here. These are borrower paid rates, but here are the rates: 5 5/8 for the portfolio select, and our non-prime, which is usually a little deeper credit, is gonna be 6 1/4. So again, high level, you got to be 24 months from a bankruptcy, 24 months from a foreclosure, and you need 6 months reserves. So
what if somebody's asking, hey man, show me that on a 620 FICO?
Okay. Yeah. Sure.
What do we got? Yeah.
Yeah. Okay. So we'll change it to 620. Give it a second, just from the connection. So we asked for a 70, but we can get to an 80 on the portfolio select. Obviously, the rate, as you go down the FICO bands, the rates go up a little bit. 675 on the one program. Similar reserves, 2 years from foreclosure or a housing event. And so you can play around with this. You can keep changing the LTV. You can change the credit parameters. You can change it. Let's see. Let's go here, and I'll go to, instead of full doc, we'll say 24 months business bank statements. Boom, says, okay, yeah, we'll give you this. We'll give you the 75 you requested, but we'll do up to 85 for that borrower. And again, it just click and it recalculates. It gives you starting points. It's really just to have a conversation with your borrowers that, hey, it looks like there are some options. And let's say, so you've spent 1 minute inputting this information. You've had a conversation with the borrower, or you know the borrower's situation, and you want to find out more, because this isn't really an approval at all. This is simply extremely high level. Hey, quick quote. What kind of deal? What might this look like if it was a deal? So to take it to the next level, it's very simple. From here, you click right here, pre-qualification request. When you hover on top of it, it lights up, so you know it's a link, and you click on that, and it just takes you. We just need a little bit more information, really, about yourself. You would pick. I don't have an account executive, or you pick from our list of who you work with locally. Fill in some information, upload a 1008, a 1003, and a credit report, and hit submit. And when you do that, that goes to the AE, and we'll have you a pre-qual, which will mean a very solid approval of a loan program that we can get that borrower into. Those will be within 24 hours. So
that's pretty awesome.
Send it this afternoon, and you'll have something back by end of business tomorrow.
I mean, that's easy to sell. It's like, well, let's just do this. Let me just get started. Let's just run out the flag. We'll have an answer by tomorrow. You know what I mean? We'll see exactly what we can do. We'll see what your options are, and then we can figure out how we can make that work.
Right.
I got a quick question here. I guess one of our viewers has, I guess, a borrower in a very similar scenario. Her concern is, or her question, I should say, I shouldn't pose it as a concern, is 24 had a foreclosure 2 years ago, right? But since then opted to move in with family, and that doesn't have a reestablished house payment for the past 24 months.
Yeah.
Is that,
those, yeah, it's something we can look at. A lot of these are storied loans. So
yeah.
what's the story? That is logical, but we have to look at it. What kind of mortgage did they have before? What kind of income? And then what are they doing now? And
yeah, where's the money going? Has the money been going into the bank and they've been saving up? Hey, okay, now this is looks like there's a plan here. Yeah,
you got it. That's exactly right, Frank. Did they foreclose on a $150,000 mortgage and now they want a $400,000 mortgage? Or there's just a lot of questions to ask on top of that. So yes, we'll consider things like that. Again, what's the story behind the loan?
One more question.
Yeah, sure.
Can I ask? Okay.
Absolutely.
Good question too. If you go through the scenario, you get your quick quote. You went ahead and did the pre-qual. You uploaded the stuff. Boom. Is Angel Oak sending out disclosures at that point?
So yes, actually.
Okay.
First, back up a little bit. You do have to be approved with us, and you can see right here on the website, broker package. You have to get approved. So before we can disclose to a borrower, all the documentation is here. And in fact, I'll back up a little bit more even. How about contact us? Find an AE. You need to make contact with someone at Angel Oak that can help you. So you can see all the states. You click on a state, and it's going to pop up who's available to help you in that state and which markets they're in. So there's their phone number, email, really simple to reach out to. So once you do that, you contact them, go to the broker package, get a broker package, get approved. A lot of you might be with a company that's already approved with us, and we just need to approve you and or your branch and you. So easy, one little form, fill it out, and we get you put in our system. So yeah, the process would be we would disclose to the borrower, disclose the fees. We issue the LE. We do e-sign, DocuSign, things like that. So it's real simple. It's real quick. Our average turn time, because we get asked that a lot. There's a lot of assumptions about our space, but the average turn time from start to finish, even including a couple days for a pre-qual to get done, is about 24 days from start to finish. So we work. Do a lot of purchases. We understand that there are contract dates, and these contract dates don't change regardless if a borrower wasn't able to qualify for that conventional Fannie Mae loan. The contract date is still something that we have to hit, and we work real hard to turn these loans quickly to get those done.
Cool. What about marketing materials? What's Angel Oak got for us? For that.
That's a great point, because again, education is key, and we put these, once you're approved. Now absolutely have to qualify. You have access to these if you are approved with Angel Oak. So on that main site, you click log in, and it'll take you to this screen. We have a new portal, so I thought I'd just give it a little plug right here. It's our new portal, just rolled out last month. It's super easy, super fast. It's been getting rave reviews from our customers. So anyway, you would go to this portal. You, as an approved LO, you'd get a username. You set your password. You log in, and when you're logged in, you'll see right on the top, marketing flyers. So here's the broker flyers, and we have lots and lots of them, and you can see the supply of them, and they're all. I'll click on just one. Here's the bank statement one. That's one that a lot of people use. The bank statement flyer. Click here to insert your logo. So these are not Angel Oak flyers. These are your flyers. Put your logo at the top. Tell a little bit of high-level information about it, and then you put your information on the bottom. Your name, contact information, email, and so these are yours to use. You can print them. You can save them, email them, however you want to do. They're yours to keep and yours to use.
That's cool. Are we able to maybe give them one as a freebie for?
Yeah.
Okay, so they could kind of get something in their hands and run with it, because they might not, they might want to go dig up in some interest and then go through the approval process.
Oh, absolutely. Yeah. Happy to do that. Again, it's education. The other piece that I always love to say is work with your AE, because our AEs are there as a resource for you to become an expert on these loans, but also we're there to help you market. You know, if you have a realtor presentation and want an AE to go along with you, call your local AE and they'll be happy to do it. We do it all the time, and I think it does make a big difference and gives you a lot of confidence that, you know, if somebody asks you a question you're not clear, you've got an expert by your side to help.
That's been awesome. I'm looking at the questions. There's really not anymore. There is one. It's a good one. It's a good one. You know, some LOs are going to be kind of concerned about it. What's the exposure or liability for a non-QM? I'm assuming to the originating broker or mortgage banker that sent you the deal. What's their exposure on it?
That's a great question, because that's one thing that was a bigger concern a few years ago. But so every one of our loans, if you notice, bank statement, regardless of the type, we have to have a documented ability to repay. So ATR applies to all of our loans.
Right.
So there is no exposure because we're documenting that ability to repay. It might be alternative. We're using bank statements, but you know, again, this goes back to the performance. We now have like 4 years of performance. So we have proven that our guidelines and our documentation process is able to identify borrowers that have the ability to repay.
Right.
So the only risk that you have doing business with us is if you're involved with fraud. You know, if it's a fraudulent file, that's the risk that you have. But as far as the loans themselves, there's nothing about the performance. Although I can say we've originated well over 4,000 loans, and we can count our defaulted loans on one hand. So you know, there's not a performance concern even.
That's cool. That's awesome. And I know that's exactly what that person was looking for. So, I mean, to summarize, even though they're non-QM, they still have to conform to ATR. That, you know, you have to have the ability to repay. So it's a different world. It's not like it was years ago. There's really no more questions, and we're just people saying great, thank you, that type of thing. There's a couple I left in there that the AEs are going to have to get to, so your guys can do a little bit of work there. But with that, I think we'll go ahead and sign this thing off. I love our timing. We did it in under an hour. We're only 10 minutes to the top of the hour, so I think everybody's going to be happy about that. Your giveaways, guys, you're going to get at least one marketing flyer from Angel Oak that you can use immediately in your marketing efforts, whether you're approved or not. Don't forget about the website that you can go to get your quotes and run your pre-quals.
I put my phone number and emails on the screen, so anybody who wants to reach out to me directly, please do. Happy to help any way I can.
Excellent. It'll be on the email as well that you guys get with the recorded webinar, etc. And on our end, from the National Real Estate Post, of course, Pre-Op 1003 is one of our proprietary products we're owners of, so we'll give you guys 30 days free on that if you're interested in it, because you could actually use that in conjunction with Angel Oak products to stir up some business. You could literally say, for more info, text, you know, Frank Garay to 48421 or whatever, and you can get some leads and, you know.
Yeah, that's a great tool.
We'll give you guys that. We'll get the recording out. Everybody saying thank you so much.
Awesome.
They love it. I loved it. It was terrific. The recording one will go out. We're done. I think we're good.
Awesome. Thanks everybody for attending. Frank, appreciate it as always.
Me too, man. Great stuff. And we'll be back again next month with something else.
Good deal.
Sound good?
All right. Have a good one.
All right.
Thank you. All right. Bye. Cheers.